Okay, day 7 of the 21-day property investors course. We're looking at avoiding loss in property investing and with mortgages. So creating financial freedom, that's a long-term game, and a lot of people come into property investing or they've had a mortgage for a while and they're starting to think, all right, I gotta get passive income up, I gotta get financial freedom, I gotta get ready for retirement. There's young people in their 20s and 30s that feel like I gotta do this now, and then there's people that get in their 50s and 60s that are panicking that they haven't figured out retirement. Unfortunately, most of the time property investing is a long-term game. You just have to understand that from the start. That doesn't mean that you can't achieve what you want to achieve, you just need to keep that in the front of mind. The first 2 rules Warren Buffett has about investing is don't lose money, and remember the first rule. You can't be speculating with property investments and expect to win every time. So we've got to be setting ourselves up for success by not losing money in our property investing. Now with property investing in New Zealand, the good thing about it is that values generally, over the long term, they keep going up. We look at history, go back 10, 20, 30, 40, 50, 100 years, all property values in New Zealand have gone up. There's volatility, but when they say safe as houses, they mean it. In New Zealand, because the population is going up and because there's a lot of demand and interest in living in New Zealand, I think it can be fairly expected that over the long term that property values will keep going up. So in terms of not losing money, buying property in New Zealand is a relatively safe investment. Now with inflation at the moment, the good thing about inflation for property investing in New Zealand is that it erodes away the debt. Now what does that mean? Let's say you bought a 100k house say 20-30 years ago, let's go 30 years ago, and you got 100k of debt, 100% financed that property. Now if you never ever paid off that debt for the last 30 years and now that property is worth 2 million, then what you have, because of the inflationary pressure and house prices going up in value, what you have now is 1.9 million of equity, and you've still got that 100k of debt if you've never paid it off. But there's plenty of people that bought houses 30 years ago that were 60 grand, 100 grand that are now worth $2 million, and it can be fairly expected that in 10, 20, 30 years, $2 million house is going to be $4 million or $10 million. The price of what a dollar gets you now, it's going to change. There's going to be inflation, and we're seeing that already at the moment. The mistake I see a lot of people making with property investing is they start thinking about it as hunting. They're looking for that big kill. They're looking for the perfect investment option that's going to feed them for a really, really long time. Now there are those kinds of deals out there, but a fishing mentality I think is more appropriate. Fishing requires patience, it requires preparation, it requires adjustments, and it also involves like throwing things back if it's not the right fit. So it's just having that right mindset, the mentality is going to help you avoid loss, and that's what it's all about. So why do people fail or lose in property investing? Now there's 5 high-level reasons. So the first is preconceptions. Preconceptions meaning that maybe property investing is dangerous or risky, or maybe they've had a previous experience where they've lost money through property investing, or they've heard about other people that have. I would challenge that and just say, hey, if you're not going to be buying properties, then how are you going to get to financial freedom? How are you going to create that income for life? If you have a better alternative, the share market, small business, inheritance, lotto, like if you have a better alternative than property, then by all means avoid what you might feel to be as risky. The thing is, property, all things held constant, is the safest investment option for most New Zealanders. So you really got to challenge that mindset that, hey, the market's going to crash, it's really a terrible time to buy, because people have been saying that, they always say that. And maybe the property market drops 10% the day after you buy, but it's not, if you're doing everything's right, it's not going to be the thing that puts you into bankruptcy. As long as you hold and the fundamentals are good, then buying property that drops in value the next day is totally fine, because in the long term it's going to make it back up. Now the second reason is short-term thinking. Short-term thinking is, hey, I'm just going to wait for this. Hey, I'm just going to wait for that. Or I can do this then. Short-term thinking doesn't help you escape out of that rat race. You've got to have more long-term thinking, because that's how we're going to get to financial freedom. It's in a 10-year period, every 2 to 3 years, buying a property and actually really sticking to it, and knowing that you're not going to be able to just one day decide you're going to buy a property and find the right one on that day. It's that you're going to have to create habits that every 2 to 3 years are going to find the right property. That means taking the necessary action with property filters, talking to agents, getting approvals, knowing that you're going to have to take action sometime. Unclear goals, I think, is a really big problem for a lot of people. Is they don't have financial freedom in their sights. They don't have a plan. They don't have an agreement with their partner or their family about financial freedom being really important. And so with no goals, there's generally very little action, and those years turn into decades and people don't get what they want. That kind of ties in with reacting and waiting. People sometimes expect that the right deal is just going to find them magically. There's going to be a lot of work required to find good deals, and it's not surface level just going to jump out and say, I'm a really good deal. You're going to have to look at things and understand the moving parts and uncover how those deals are good. You have to be proactive, not reactive. And my favorite is the numbers. People are going to fail or lose money if they don't understand the numbers. You really need to have somebody on your team that understands yields and understands definitely around the finance side of things, so that you don't get caught out with a property that's going to cost you a lot more than you realized, or it's not going to have the gains that you're anticipating. To avoid getting into a situation where you are caught out by mistakes, before you buy a lemon of a property, before you lock in the wrong structure on your mortgages, before you buy the wrong property in the wrong place, before you sell a property and attempt to buy something else and get caught out, before you lock in any terms or any agreements, just think, why am I doing this myself? Why am I not getting help? Why don't I have this person and this person and this person on my team, or giving me insights before I make these decisions? And just think about how funny it would be to have someone who's not handy and has no automotive skills, for example. Imagine if I said to you, hey look, I'm going to change the engine of my car, and I know nothing about cars. Imagine you're a mechanic and you've got a guy that knows nothing about cars changing an engine or changing spark plugs or whatever. It would be a laugh a minute. It would take me 10 times, if not 100 times longer than somebody with expertise. And the hourly rate difference is like, I should just pay someone to do what I need done, because it's going to get the outcome and help me avoid loss. So just imagine your job and somebody trying to do your job and has no idea how to do it, trying to do it, how funny it would be. And that's sometimes what happens when people try and do the mortgage and property stuff and legal stuff on their own without getting experts involved. You might save $100 here and there, but sometimes it's going to cost you 50 or 100 grand of lost compounded return, or even direct costs. So just try to remember that we're not trying to do everything ourselves. We're trying to avoid loss. And part of avoiding loss is working with professionals and experts and people that have done this sort of thing before. And I would just be saying, hey, make sure you understand the numbers and you've got good, clear goals. Long-term thinking is great, but long-term thinking with action is important. Any questions? Let me know in the comments.